Preparing for an investment banking interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does an investment bank actually do? An investment bank helps companies, sponsors, and governments raise capital and execute strategic transactions. On the advisory side, it supports mergers, acquisitions, divestitures, and restructurings. On the financing side, it helps issue equity, debt, or hybrid securities. Unlike a commercial bank, the core product is advice and market access, not deposits. The bank earns fees for successful transactions, underwriting, and advisory mandates. So execution quality and client relationships matter heavily. While answering, focus on advisory and capital raising, distinguish investment banking from commercial banking, and explain how banks earn fees through M&A, IPOs, debt offerings, and strategic advice. Question 2. Why do you want to work in investment banking?
I want investment banking because it sits at the intersection of finance, strategy, and execution.
I like that the work is transaction-driven, with real consequences for companies and investors. It also offers a steep learning curve. Valuation, accounting, capital markets, and negotiation all show up quickly. I understand the hours are demanding, but I'm motivated by a high-performance team environment where accuracy, urgency, and client service are non-negotiable. Make sure to cover your interest in transactions, steep learning curve, exposure to senior decision-makers, analytical rigor, and willingness to work in a demanding team-based environment. Question 3. Walk me through the 3 financial statements. The income statement shows profitability over a period, starting with revenue and ending with net income. The balance sheet is a snapshot of assets, liabilities, and equity at a point in time. The cash flow statement explains how cash changed, splitting activity into operating, investing, and financing cash flows. Net income links to cash flow from operations, then to retained earnings on the balance sheet. Ending cash from the cash flow statement flows back to the balance sheet. In your answer, explain the income statement, balance sheet, and cash flow statement. Then connect net income, retained earnings, depreciation, working capital, CapEx, debt, and cash. Question 4. If depreciation increases by $10, how do the financial statements change? Assuming a 25% tax rate, a $10 increase in depreciation reduces pre-tax income by $10 and taxes by $2.50, so net income falls by $7.50. On the cash flow statement, net income is down $7.50, but depreciation is added back by $10, so cash from operations rises by $2.50. On the balance sheet, cash increases by $2.50, PP&E decreases by $10, and retained earnings decrease by $7.50. Be sure to mention tax impact, lower net income, add back in cash flow from operations, changes to PP&E, cash, retained earnings, and why the balance sheet still balances. Question 5. How would you value a company? I would triangulate valuation using several methods rather than rely on one number. A DCF estimates intrinsic value based on projected free cash flow and discount rate. Comparable companies show how the market values similar public companies today. Precedent transactions show what acquirers have paid for similar assets, including control premiums. Depending on the situation, I might also use an LBO analysis or sum of the parts valuation. The output should be a defensible valuation range. While answering, cover intrinsic and relative valuation methods, including DCF, comparable companies, precedent transactions, and when each method is more or less useful in practice. Question 6. Walk me through a DCF valuation. A DCF values a business based on the present value of its future free cash flows. First, I project unlevered free cash flow, usually for 5 to 10 years. Then I calculate terminal value using either the perpetuity growth method or exit multiple method. I discount the explicit cash flows and terminal value using WACC to get enterprise value. From there, I subtract net debt and other claims to reach equity value, then divide by diluted shares. Make sure to cover projecting free cash flow, calculating terminal value, discounting cash flows using WACC, deriving enterprise value, and bridging to equity value and share price. Question 7. What is WACC and why is it used in a DCF? WACC is the weighted average cost of capital, or the blended return required by debt and equity investors. In a DCF, it is used to discount unlevered free cash flow because those cash flows are available to all capital providers. The cost of debt is adjusted for taxes because interest is tax deductible. The cost of equity is usually estimated with CAPM. The key is matching the discount rate to the cash flow type. In your answer, define WACC as blended cost of capital. Explain debt and equity weighting, tax shield on debt, and why it matches unlevered free cash flow. Question 8. How do you calculate unlevered free cash flow? Unlevered free cash flow starts with EBIT because we want operating income before financing costs. I tax-affect EBIT to get NOPAT, then add back depreciation and amortization since they are non-cash expenses. Next, I subtract capital expenditures because they are real cash outflows needed to maintain or grow the asset base. Finally, I subtract increases in net working capital or add decreases. The result is cash flow available to both debt and equity holders. Be sure to mention EBIT, taxes, NOPAT, adding back non-cash charges, subtracting capital expenditures, and adjusting for changes in net working capital. Question 9. What is the difference between enterprise value and equity value? Enterprise value represents the value of the company's core operating business to all capital providers. Equity value represents the value attributable only to common shareholders. To move from enterprise value to equity value, I subtract debt, preferred stock, and minority interest, then add cash and non-operating assets. The distinction matters because operating metrics like EBITDA are compared to enterprise value, while earnings and share price metrics are compared to equity value. While answering, explain enterprise value as value of operations to all capital providers, equity value as value to shareholders, and bridge using net debt and non-operating items. Question 10. Why do we subtract cash when calculating enterprise value? We subtract cash because enterprise value is meant to capture the value of the operating business, independent of excess cash sitting on the balance sheet. If I buy a company, I effectively receive its cash, which can reduce the true purchase cost. That is why we typically use net debt, meaning debt minus cash. In practice, bankers may distinguish between excess cash and minimum operating cash, especially for businesses that require cash to operate. Make sure to cover cash as a non-operating asset, the acquirer effectively receiving cash at closing, excess versus operating cash, and the link to net debt. Question 11. What are comparable company multiples and how would you select a peer group? Comparable company analysis values a business by looking at how similar public companies trade in the market. Common multiples include EV/EBITDA, EV revenue, and PE. I would select peers based on business model, end markets, growth profile, margin structure, scale, geography, and capital intensity. Industry classification alone is not enough. After calculating multiples, I would review outliers and apply a reasonable range to the target's relevant financial metric. In your answer, discuss trading multiples, peer selection by business model, size, growth, margins, geography, and why judgment matters more than blindly using industry labels. Question 12. Why might precedent transaction multiples be higher than trading multiples? Precedent transaction multiples are often higher because buyers pay for control, not just a minority trading stake. A strategic acquirer may also expect cost or revenue synergies, which lets it justify paying more. Auction tension can push prices higher, especially for scarce assets. That said, transaction multiples can be distorted by market cycles, deal structure, buyer-specific synergies, and unusual asset quality. I would use them carefully, not mechanically. Be sure to explain control premiums, expected synergies, competitive auction dynamics, market timing, strategic buyer behavior, and why transaction multiples are not always directly comparable. Question 13. Which valuation method usually gives the highest value, and why?
There is no guaranteed ranking, but precedent transactions often produce the highest valuation because they include control premiums and sometimes expected synergies. Trading comps often show a lower value because they reflect minority stakes in public markets. A DCF can be higher or lower depending on assumptions for growth, margins, terminal value, and discount rate. The right answer is that valuation methods create a range, and the analyst must understand what each method is really measuring. While answering, avoid absolute rules. Discuss precedent transactions, DCF sensitivity, trading comps, control premiums, synergies, and how assumptions drive the final valuation range. Question 14. What is EBITDA, and why do bankers use it? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Bankers use it because it approximates operating profitability before capital structure, tax regime, and non-cash accounting charges. That makes it useful for comparing companies with different leverage or depreciation policies. But it is not true cash flow. It ignores capital expenditures, working capital needs, and sometimes stock-based compensation. So I view EBITDA as a helpful shorthand, not a complete measure of economic value. Make sure to define EBITDA, explain it as a proxy for operating cash flow, discuss comparability, and mention limitations such as CapEx, working capital, and accounting adjustments. Question 15. Explain accretion and dilution in an M&A deal. Accretion and dilution measure whether an acquisition increases or decreases the buyer's earnings per share. A deal is accretive if pro forma EPS is higher than standalone buyer EPS, and dilutive if it is lower. The result depends on the target's earnings, purchase price, financing mix, interest cost, new shares issued, synergies, and transaction adjustments. Cash deals may be accretive if the target's earnings yield exceeds after-tax interest cost or lost cash interest. In your answer, define accretion and dilution based on buyer EPS. Cover purchase price, financing mix, synergies, interest expense, shares issued, and amortization impacts. Question 16. A company with a 10 times price-to-earnings ratio buys a company with a 5 times price-to-earnings ratio using stock. Is the deal accretive? All else equal, yes, it should be accretive if the buyer uses stock, and there are no major transaction adjustments. A 10x PE means the buyer has a 10% earnings yield, while a 5x PE target has a 20% earnings yield. The buyer is issuing relatively expensive stock to acquire a cheaper earnings stream, because the acquired earnings per dollar of value exceed the earnings given up through new shares. Be sure to explain earnings yield, share consideration, relative PE, no synergies assumption, and why the lower PE target generally makes a stock deal accretive. Question 17. What are synergies, and how do they affect valuation? Synergies are benefits a buyer expects from combining two businesses. Cost synergies might come from eliminating duplicate headquarters, consolidating vendors, or reducing overlapping staff. Revenue synergies might come from cross-selling or expanded distribution, but they are usually less certain. In valuation, I would estimate annual synergy run rate, tax affect it, apply timing and probability assumptions, and discount it. Buyers often pay away part of synergy value to win the deal. While answering, distinguish cost and revenue synergies, explain timing and execution risk, tax affecting, present value, and why buyers may share synergy value with sellers. Question 18. Walk me through a basic LBO model. An LBO model evaluates whether a financial sponsor can earn an attractive return by buying a company with significant debt. First, I calculate the purchase price and sources and uses. Then I project operating performance and free cash flow, which is used to repay debt. At exit, I estimate enterprise value using an exit multiple, subtract remaining debt, and calculate sponsor equity proceeds. The key outputs are IRR and multiple of invested capital. Make sure to cover purchase price, debt and equity funding, operating projections, debt repayment, exit multiple, sponsor equity value, IRR, and money-on-money return. Question 19. What makes a company a good LBO candidate? A good LBO candidate has predictable cash flow because debt repayment is central to the investment case. I would look for stable revenue, strong margins, modest capital expenditure needs, and limited working capital volatility. A defensible market position and experienced management team are also important. The company should have enough debt capacity without excessive downside risk. Additional upside can come from pricing improvements, cost reductions, add-on acquisitions, or multiple expansion at exit. In your answer, discuss stable cash flows, low capex needs, strong margins, defensible market position, debt capacity, asset base, management quality, and potential operational improvements. Question 20. How does leverage increase returns in an LBO? Leverage increases returns because the sponsor funds less of the purchase price with equity. If the business performs well, its cash flow repays debt over time, and the remaining equity value at exit belongs to the sponsor. For example, buying a company for $100 with $60 of debt and $40 of equity creates more equity upside than paying all cash. But leverage cuts both ways. Weaker performance can quickly impair returns or trigger covenant issues. Be sure to explain reduced equity contribution, debt repayment with company cash flow, fixed claim nature of debt, upside to sponsor equity, and downside risk. Question 21. What is net working capital, and why does it matter in deals? Net working capital is operating current assets minus operating current liabilities, usually excluding cash, debt, and non-operating items. It matters because growth can consume cash through receivables and inventory, while payables can temporarily provide funding. In M&A, buyers want the business delivered with a normal level of working capital, not starved before closing. That is why purchase agreements often include a working capital target and true-up mechanism. While answering, define operating current assets minus operating current liabilities, exclude cash and debt, explain cash flow impact, purchase price adjustments, and normalized working capital targets. Question 22. What happens if accounts receivable increases? If accounts receivable increases, it means the company recognized revenue but has not yet collected cash from customers. There is no immediate impact on the income statement if the revenue was already recorded. On the balance sheet, accounts receivable increases as an asset. On the cash flow statement, the increase is a use of cash within working capital, reducing cash flow from operations. This is why earnings growth without cash collection can still create liquidity pressure. Make sure to connect revenue recognition versus cash collection. Explain impact on net working capital, cash flow from operations, balance sheet assets, and no immediate income statement change. Question 23. Walk me through the M&A sell-side process. A sell-side process starts with preparation, positioning the company, building a valuation view, creating a teaser, confidential information memorandum, and buyer list. The bank contacts potential buyers, executes NDAs, and shares materials. Interested parties submit initial indications of interest. Then selected bidders enter deeper diligence and attend management presentations. Final bids follow, including price, financing, and contract terms. The seller chooses a buyer, negotiates definitive agreements, signs, and closes after approvals and conditions are satisfied. In your answer, cover preparation, marketing materials, buyer outreach, confidentiality agreements, management presentations, indications of interest, bids, diligence, negotiation, signing, and closing. Question 24. What is an IPO, and what role does an investment bank play? An IPO is the process of selling shares of a private company to public investors for the first time. The investment bank advises on valuation, market timing, positioning, and offering structure. It helps prepare the prospectus, coordinate diligence, educate investors, build the order book, price the deal, and allocate shares. The bank may also provide underwriting and aftermarket support. The goal is to raise capital while establishing a credible public market valuation. Be sure to mention taking a private company public, underwriting, valuation, investor education, regulatory filings, book building, pricing, allocation, stabilization, and aftermarket support. Question 25. If a client asks whether to sell now or wait, how would you think about the advice? I would frame it around both company-specific readiness and market conditions. If performance is strong, forecasts are credible, buyer appetite is high, and financing markets are open, selling now may maximize certainty and valuation. If the company has near-term growth milestones, margin improvement, or unresolved issues, waiting could create value. I would also consider shareholder objectives, competitive dynamics, tax implications, and alternatives like refinancing, minority investment, or dividend recap. The advice should balance value and execution risk. While answering, frame the decision around valuation, company performance, market conditions, buyer appetite, financing markets, execution risk, shareholder objectives, and alternatives to a sale. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.